And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking, proud host of Beyond the Budget 2025, where they are reimagining inclusive and sustainable economic growth. Good evening. Welcome to The Money Show tonight, day 2 of what I suppose we would call the post-non-budget, fracas, maybe, if the coalition doesn't sort itself out, fiasco, perhaps. For the moment, no real development in what I think absolutely matters. We're getting a much more complete picture, thanks to the work of journalists like Carol Payton and others, about what exactly happened and what led up to it. What I haven't seen anyone talk about today is any negotiations between the parties. And I realize it's easy to say on the 20th of February that the deadline is the 12th of March. I don't think it is. The Treasury, if you look at the amount of work, the number of documents, the amount of information that is put together in a normal budget briefing, and all of that was sort of unembargoed late yesterday. But if you look at that, some of that will have to be changed. And I would suspect that, in fact, the real deadline is probably a week or so, maybe even more, before the 12th of March. And for the moment, I've heard nothing about negotiations. Of course, the President, Cyril Ramaphosa, he's been busy, along with other officials, at the G20 Foreign Affairs meeting that's happening at Nasrec in Cape Town. And just a sort of thought, we'll flesh this out a little bit more with Sanisha Naidu in a while. If the United States is determined to go it alone, and certainly it looks like its leadership is, and the G20 becomes the G19. We already know of 2 meetings at which their secretaries are not coming. Well, then it would sort of make you wonder if this is a moment to kind of take charge of a multilateralist world. President Ramaphosa might well feel that he's very well equipped to do that. And I'd suspect politically he actually is, if you consider the position in which he finds himself right now. We'll look at that a little later. Gold, for the first time ever, passing $2,950. And it does still seem that despite being at record highs, gold is a good buy. It's just the feeling that I think the market has. Trump's making it a good buy. We'll talk a little bit about risk tolerance in investment school from 7:30 this evening. And risk tolerance obviously can depend where you are in our society, what you're doing, how much longer you are planning on investing for, things like that. But in a way, do you invest in US tech shares? Do you invest in gold? That really does get to your risk tolerance. Good to hear from you tonight. What would your negotiating point be in the budget? 011 8830 702 021 446 0567. And of course, voice notes tonight on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
What a day to be a gold miner. New record gold price today. Expectations that it will hit $3,000 an ounce. And then Gold Fields reporting its profit jumping by 77%. Obviously on higher gold prices, earnings up to $1.25 billion. Mike Fraser is the CEO at Gold Fields. Mike, good evening. Thanks so much for your time tonight. You point out that there was quite a big turnaround in the second half of last year in your operations. Obviously, gold prices where they are is a big factor. What else was changing in your company that helped you to take advantage of that?
Hi, good evening, Stephen. Thanks for having us on your show tonight. Yes, absolutely. So we talk about 2024 performance as being a year of 2 halves. We already had a planned weighting to performance in the second half, particularly as we'd planned ramping up our key project at Salares Norte in Chile. We had significant weather events, however, in the first half of the year, both in Australia, impacting our Gruyere mine, as well as delaying the ramp-up of Salares. And then we also had some challenges at South Deep in the first half of the year. We were able to get ahead of those challenges, and certainly that enabled us to contribute to a much stronger the second half, where we saw our attributable production up 26% on a half-and-half basis. So, I would say the first half was extremely disappointing from a performance point of view, but the team really pulled together. We built some really strong alignment, and were able to deliver the turnaround in those 3 key operations.
The Salares Norte project in Chile, I mean, it's an open pit mine, but it's very, very high. So I presume when you have bad weather, it has all sorts of impacts, and you can't control that.
Well, Stephen, I think the way we should characterize it is that, in fact, mining has been the least of our challenge there. So we've been able to really be successful in mining the key deposit there, the Brescia Principal pit. We've been able to get a huge amount of high-grade stockpile in front of the plant. The problem really is that we were only able to really start the ramp-up at the end of March and into early April, and literally 2 weeks after we'd started the planned ramp-up, we had some significantly severe weather events coming through, which curtailed our ability to process material through the plant. And that became kind of a theme through the winter months. So it was really only once winter had really thawed out that we were able to start preparing for a more significant ramp-up. And pleasingly, in the fourth quarter, we saw the ability and the potential of that plant, where we were able to deliver 45,000 ounces in the last 3 months of the year. So I think we're in a much better place than we were in the start of last year. And I think, probably one of the key lessons for us is trying to commence a significant ramp-up of a plant like this at the beginning of winter was something that was always going to be a challenge for us.
Those issues, you refer to them at the South Deep mine, the second half also a lot better. Are those problems now sort of permanently resolved?
Yeah, and I think the first thing we should say is that South Deep is a fantastic deposit. It is a world-class deposit, and we're very fortunate to have it in our portfolio. And I think South Africa is certainly blessed to have a deposit like that remaining in our ore bodies. But we are mining at 3,200 meters below surface, so you're always going to find challenges emerging from time to time. But however, the challenges that we had in terms of backfill leakages, really difficulty in getting stope turnaround in our mine underground, we were able to get ahead of those challenges in the second half, and certainly we saw a very, very strong performance out of South Deep in the second half of the year, where they also had a 28% improvement in production half on half. So a really strong performance out of that team at the end of 2024.
You're expecting your production to increase in this financial year by 18%, quite a significant increase, obviously a good time for that to happen. What are you basing that on? I mean, is it just simply more progress on the problems in resolving the issues, more progress on the projects that you've already been talking about?
Yeah, so I think you quite rightly call out, one of the things that is really fortunate for us at Gold Fields is we have a really great project pipeline over the next number of years. Salares Norte ramping up. In 2025, we've got around 320,000 ounces of additional production that we expect to see coming through in 2025, which helps us quite considerably. And then we have full ramp up into 2026, where it gets closer to nameplate, between around 550,000 ounces. And then in 2028, we have Windfall project coming in. So these are really high quality, low cost production coming through. In 2025, we also see some improvement in performance in Australia, across our Australian operations, as well as South Deep, where we expect to see more ounces produced. Some of that is offset by our production in Ghana, which is really just a sequencing of how we're mining the Tarkwa deposit. So all in all, a bit of internal improvement from our current assets, but absolutely a significant contributor from Salares Norte.
A lot of speculation, Mike, that the gold price will hit $3,000 an ounce. Lots of people are saying it will happen. No one is saying when it will happen. Your crystal ball, though, gold going to stay at these levels for long? I mean, the World Gold Council seems to think so, that actually the gold price is going to be in this phase for a little while.
Yeah, look, I think the first and foremost, I'd say that we don't plan for these prices. Clearly, we're living in a very happy place at the moment, where we're able to generate significant amount of cash, enables us to reinvest in the business and deliver very significant returns to our shareholders at this time. But if you just look at the macros around gold, I think we've been supported on a number of fronts. Firstly, with the whole global turmoil, the discussion around tariffs, it's really providing a basis for gold to be considered a safe haven, as it always has been. We expect inflation to be sticky for longer, which is supportive of gold. And then you've got that demand driver, particularly around demand in Asia, both central bank as well as retail and investment buying. And then you're also seeing a slight flow back into the ETFs in Europe. So, all in all, we've got some really good support for gold prices. There may be some tactical retreats at these levels because people are now probably starting to think about, do you take some money off the table? But going back to one of your early comments when I listened in, I think if you just look back over the decades, gold has really got a place in portfolios, and I do believe that, gold in portfolios have outperformed portfolios without gold over many decades. But I also think that if you look at it today on an investment basis, funds are pretty light on a relative basis on gold. So, maybe there's an opportunity, but certainly we don't plan for these prices. But personally, I think it's got a bit more to run.
Mike Fraser, really appreciate it. Thank you very much indeed. CEO at Goldfields.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
So over time, I think a more complete picture beginning to emerge of what really happened yesterday in the hours that led to the announcement in Parliament that the budget was going to be postponed or delayed. It was a shock. I was sitting in the studio that I'm sitting in right now when it happened, and I was deeply surprised. Some people who are very, very well informed seem to think that maybe it wasn't that surprising, but there was a series of developments that led to this. Carol Payton is an editor-at-large at Fin24, been looking into this, and I suspect maybe was a little less shocked than most of us. Carol, good evening. We know the point of dispute was the 2 percentage point VAT increase. When was it clear to the people involved that there was going to be a dispute at this scale?
Well, I think actually only on the morning of the budget did it become clear that there was going to be a large opposition within the cabinet to this move. But they had in fact been warned ever since they actually made it clear that this was going to happen, or sort of made it sort of clear this was going to happen. They had been warned that this would not be supported. So they had warnings. They decided not to take them seriously. And I think then on the morning of the budget, it became clear that the budget could not proceed.
There are lots of people to point fingers at, but the Finance Minister, Enoch Godongwana, surely, I mean, it's easy to say after the fact, I suppose, but a 2 percentage point hike in VAT was always going to be close to impossible politically.
Exactly. So what he did and what the Treasury did was, because there was obviously going to be massive political opposition, they kept this very close to their chests. And even when they presented the budget to the Cabinet on the 5th of February, which was supposedly the budget, the final thing, they did not say that they were going to raise that by 2%. What they said was, we are thinking of raising taxes and we are likely to target VAT, and didn't put a number on it and didn't make it a very firm, it didn't make clear it was a very firm intention. So that's the way they handled it. The argument for doing it that way is to say, well, this is market-sensitive information and we couldn't take a risk that it would leak. But at the same time, they instead took a massive risk that it wouldn't be accepted.
Where was the president during all of this? From your report, it sounds like he was on a plane. He wasn't in the cabinet meeting.
Well, no, I don't know if he's dialed in virtually. I don't know, but in the cabinet meeting of yesterday, which was not an emergency cabinet meeting, they always have a cabinet meeting just before the budget. This is normal, but obviously not with such a big surprise contained. And the president was supposed to fly into Cape Town for the meeting, which was arranged particularly so that he could make it at 12 midday, and then couldn't. And we haven't got to the bottom yet of why his plane couldn't fly, but that was what happened. And so he was not physically in the cabinet meeting. Whether he dialed in remotely, I don't know. But he didn't chair the cabinet meeting that was chaired by Deputy President Paul Mashatile.
So we have a situation where the president's not in the room. We have the cabinet meeting where it becomes clear that there's going to be a VAT increase of 2 percentage points. And I remember the presidency minister, Khumbudzo Ntshavheni, yesterday saying that ministers speak in order of seniority. I'm paraphrasing here, and that the ANC ministers would have spoken first, and some of them, as you mentioned in your report today, would have opposed this VAT increase too. And that has probably happened in the past. There would have been opposition in the ANC to certain measures the Treasury's taken. It's the fact that there's now a coalition that seems to have really changed the game. But it also means that the DA, and I presume the leader, John Steenhuisen, would have been making a decision in the cabinet meeting that he wasn't going to back it.
No, I think he had made a decision long before that. I think the DA had made that decision long before that. They did not make that decision on the morning. They communicated it again on the morning, but they didn't make it then. Whether it was, I think, yes, the GNU changes everything because the budget is no longer just a rubber stamp. Processing the budget in Parliament is no longer a rubber stamp. But at the same time, I think even if this had been an ANC-only government, to introduce it at the last minute like this to make people aware of this 2% VAT increase at the last minute when they've got like 2 hours to go to the budget would have been politically very risky and dangerous. Perhaps it would have been pushed through, but it would certainly have caused a lot of internal problems for the finance minister going forward.
Several of the key role players have been busy today. The president's been speaking at the G20 foreign ministers meeting. I've heard nothing about any negotiation anywhere to try and resolve this. Have you? I mean, that's clearly what needs to happen now. And I'll suspect, as I said at the start of the show, the deadline isn't actually the day before the budget. A huge amount of work has to be done once an agreement is reached.
Yes, I don't know. I would imagine work has begun because there's not a lot of time. They've set a date of 3 weeks to table the budget again. So I would imagine that work has begun. I know lots of the cabinet ministers and the president are involved in the G20, which started today. So maybe I doubt very much. But this is not something that anyway the whole cabinet would sit down and negotiate. This is something that I would say the Treasury needs to go back to the drawing board and come up with another option, come up with some other options. And I think the real scary part is that there are not a lot of options. There are really not a lot of options. So what they were trying to do by doing a VAT increase was they were trying to avoid blowing out the debt even further. And as you know, we've got a big debt problem in this country. It's our number one priority to reduce the debt. And that's what the finance minister was trying to do. He was trying to avoid taking on more debt by raising taxes. And at the same time, keeping within all of these spending demands, which the government and the cabinet keeps on approving and keeps on piling on year after year.
Carol Payton, thank you very much indeed. Editor-at-Large at Fin24.
The Money Show.
The markets.
Rudy van der Merwes, Portfolio Manager at Advice Works. Rudy, good evening. Gold companies, the results of Anglo American today, the results of Gold Fields. But gold shares, and if you consider the gold price, no surprises, gold shares just really running the roost today.
Absolutely, Stephen. Yeah, no, and the more marginal, the better. So DRD Gold and the like doing really well on the day. These companies obviously significant beneficiaries just at the moment of the gold price that has accelerated very, very meaningfully over the last couple of years.
It's fascinating to see how long this could go. You might have heard Mike Fraser a few moments ago suggesting that if you look at the factors that are pushing the gold price up, those factors are going to be present for quite some time.
It seems like it's, Stephen. Yeah, so I mean, a lot of it has to do with uncertainty. We did see over the last while some quite concerning developments. One of them was that the US dollar was weaponized in the sense that they used an excuse to confiscate reserves of other countries that are held in dollars. And whether you like those countries or not makes no difference. If this is meant to be the standard along which the world operates, if you undermine confidence in it, that creates a problem. So it created a spark that ignited discontent about the value of the dollar as a store of value, but probably other paper currencies as well. We've also got significant issues with sovereign debt at the moment. The US has problems, but they are certainly not the only one. Japan and China and most of the European countries also have significant debt issues, and that is concerning. We've got lots of geopolitical stress in the Ukraine and in the Middle East, and for that matter, even between China and the US around technology and around Taiwan, there's geopolitical stress. We also have uncertainty as to what the impacts of some of the new policy directions of the US are going to be. So that creates uncertainty as well. And we've seen a resurgence of late in inflation, and US inflation has accelerated quite meaningfully, and that's been on the go for some time, actually, since September last year, but also in Canada and in the UK and elsewhere. Inflation is accelerating, and that is supportive of gold. So I think there is absolutely a chance that we could see the price accelerate quite meaningfully further, and relatively speaking, compared to the major indices like the S&P 500 and the like, the gold price is not expensive at current levels.
The rand to the dollar, 18.36 at the moment. I mean, significantly stronger than it was as the budget was being cancelled yesterday. Not necessarily what you would have thought would have happened. Is the gold price a factor in that at all?
I very seriously doubt it. I think it'll have a very small impact. We are not a big gold producer anymore. Well, we are still a big gold producer, but we're certainly not in the top 10 of gold producers in the world. We're now number 12-ish. For that relationship to hold, the volatility in the amount of gold we would produce would need to be quite significant as well, and it isn't. We've sort of steadily decaying amount of gold pretty much that we produce over time. So no, it's highly unlikely. The rand's far more driven by international factors, possibly a weaker dollar, things around sentiment in South Africa. It is a little bit surprising that we've got a stronger rand so quickly, but it may also be an element of confidence in the GNU saying, this isn't a sort of push over government, and that issues of importance in the finance sector will be addressed and considered. So maybe that's returning some confidence to the domestic currency.
Rudy van der Merwe, thank you. Really appreciate it. Portfolio manager at AdviceWorks.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM, streaming on the Prime Media Plus app
and DSTV channel 856.
Well, I suppose the question that I would put to you tonight is that if you were in the room to discuss the budget, if you were with some of the cabinet ministers, some of the party leaders, what would you be whispering in their ear? What would you be saying about where to cut? What would you be saying about where to tax, if there are any places where we can tax? I suppose the question, of course, is where would you cut? And there's some obvious things. The VIP protection budget, perhaps. The fact that deputy ministers get 2 generators, one in Gauteng and one in Cape Town. I bet they still get that. Things like that. I mean, I would certainly look at that. I suppose the question really becomes, you still just wouldn't get enough money like that. You'd actually have to do it in some other kind of way. And I don't know where that would come from. And I know it's very tempting to say, oh, look at what Elon Musk is doing or President Trump is doing and tearing things up. Trust me, lots of people get hurt like that. You don't want to do it like that either. Your suggestions, not on a postcard, but on 011 883 0702 and 021 446 0567, please, tonight.
The Money Show
with Stephen Grootes.
Well, the president speaking at the G20 foreign ministers meeting in Nasrec this afternoon. He's had a briefing until just a few moments ago. That meeting runs into tomorrow. Next week, it's the G20 finance ministers. Of course, as you know, the U.S. Secretary of State, Marco Rubio, the Treasury Secretary, Scott Bessent, both refusing to come to South Africa, despite the fact the U.S. is supposed to take over as president of the G20 at the end of the year. Sanusha Naidu is a senior research fellow at the Institute for Global Dialogue. Sanusha, good evening. Nice to talk to you on The Money Show. Is the US punishing us, or are they punishing the G20, or do they just don't like either of us?
Good evening, Stephen. Lovely to be on the show with you. It's a difficult one to answer because, the whole question of the G20, again, is why was it formed initially? And the context, the history, the kind of story behind the G20 is that the financial global architecture has been in a state of systemic risk. Firstly, it started off as the finance ministers coming together after the Asian crisis of 97-98, but then it got elevated after the financial crisis of 2007-2008, which then made many of these actors, or what you may call systemic actors in the international system, realize that it cannot be, one particular actor that kind of can redress or address the solutions to the crisis. So I think that's the first point. The second point is, by going after us in the year that we are hosting the G20, but making it domestic and saying, because of your domestic policy, we don't want to come to the G20. I mean, this is par for the course for any other country which is hosting at that time, which you could say, if the G20 is happening in China, would that have been the status quo approach around the Chinese domestic issues and political questions? I think the Trump administration would have found another way in which to deal with that. But I think the challenge right now for the U.S. is, whilst we are talking about the Secretary of States, whether it's for the Secretary of State, Mark Rubio, or is it the Secretary of Commerce, who are not coming, it still goes ahead with junior level, depending what level of administration bureaucrats that they send. So they still have to be there because they're part of the troika. If they don't come, then the question would be, is what happens when they take over the presidency, if they are going to, or if they do want to chair, what are they going to be chairing the presidency of the G20 come late December and next year in 2026? And what is going to be some of those dynamics? Because then it's going to be much more critical in terms of the architecture of the global financial system and the question of what's happening in terms of global risk as you look at the World Economic Forum global risk reports.
Okay, so, the G20, as you remind us, is supposed to be a group of countries working together. It's multilateralism. Trump doesn't like multilateralism, but presumably if the US pulls out of the G20 and goes into full sort of tariff mode, right, the G20 would change. Could it become a body that is really about helping the rest of the world survive Donald Trump?
It's a difficult one I think there'll be pain. There will be repercussions. With regard to tariffs, I think you've got to understand the broader context and the broader implications, and that tariffs don't necessarily only, you don't weaponize your trade through tariffs, if that makes sense. And you don't use it as a kind of statecraft tool in order to say, I want to bring more investment into the U.S. or I want to protect the industries. It has a much more bigger macroeconomic implication. If you're looking at Elon Musk and this relationship with Trump, again, it's about what kind of engagement does the tech industry have with the administration of Trump. But in terms of whether the G20 can find a loophole, let's say they have a safety valve that they could activate in this whole process around if the U.S. decides that it's going to become more protectionist, become more inward-looking, but also don't underwrite the economic architecture. The repercussions is that the dollar is still the reserve currency in the global economy. And there will be repercussions around that because at the end of the day, it will affect how, for example, your trade happens from a structural perspective. It will affect your transactional value. It will affect your currency questions. So there are those dynamics around it. So it's not just about the tariffs. It's about what will be the kind of working away or working towards a kind of fail-safe mechanism against what's happening with the Trump presidency moving towards a protectionism. And right now, I think the challenge is that everything is interdependent and interlinked. It's like connective tissue.
Sanusha Naidu, thanks so much. Really appreciate it. Senior Research Fellow at the Institute for Global Dialogue.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Riaz on the line from Benoni. Riaz, hi. I was asking what you would whisper in a leader's ear in a negotiation about the budget. Your thoughts?
Yeah, Stephen, thanks. Actually, we should take a view from the Irish, we've got the G20 now. Ireland is a guest country under the South African presidency. we've got the Deputy Prime Minister, who's called the Minister, who holds 4 portfolios. The Deputy Prime Minister is the Minister of Foreign Affairs, he's the Minister of Defence, he's the Minister of Trade. Important portfolios entrusted to one man. And whereas we've got, I think, for the same amount of portfolios in South Africa, I think maybe we've got maybe 8, 9, 10 people running. It's a small step, but I mean, we should move away from these politicians, these demigods. I mean, we got MMCs driving with 10 cars right behind it, and you got a Dutch Prime Minister leaving office on a bicycle. No,
I mean, the difference is stark. So Gayton McKenzie should be the Minister of Sport and International Relations?
No. I mean, definitely not. No, I mean, if you look at it, there's a lot of thinking that goes behind it. And these are people that know their portfolios, and some of them are interlinked if you look at foreign affairs and trade. You know what I'm saying? So, I mean, there's a lot of overlap, there's a lot of work that can be cut out, can be more efficient, we can be a lean machine, but whereas everyone is swimming, we are going more bloated, So, I don't know if that whisper will help.
No, well, Riaz.
But nonetheless, it's something worth throwing out there and just thinking how the rest of the world operates,
No, absolutely. Riaz and Banele, thank you. From your whisper to leaders' ears, 7 minutes to 7.
You're listening to The Money Show with Stephen Grootes, brought to you by Absa Corporate and Investment Banking, reimagining inclusive and sustainable economic growth at Beyond the Budget 2025.
Well, still so many questions to look at from what happened yesterday with the postponement of the budget. And so, amid all of the fuss, I think we're now beginning to sort of ask some serious questions about how this could maybe have been avoided. Andrew Woodburn's Managing Director at Amrop Woodburn Man. Andrew, good evening. We all know there are ideological differences between the DA and the ANC, and this always comes out in a budget. I mean, Gwede Mantashe once told me that, economics is the essence of politics. Of course, he's correct. But how could this have been handled?
So good evening to you, Stephen, and your listeners. So nice to be able to reflect on this the day after, because, of course, hindsight is perfect sight, as you and I know. But certainly what does worry me, when you and I speak, we talk about leadership, we talk about people. And it's absolutely clear to me the budget was postponed. And even though we're seeing a few commentators talk about the silver lining that maybe this is democracy at work, in reality, the facts are the budget wasn't delivered on time, nor was it delivered successfully. So, what can we learn when we look at leadership against those two facts? My first view is the particular seats that should have performed. So first of all, the Minister of Finance, in my mind as a leader in this issue, certainly his role would have been to be the technical expert. He should have certainly consulted in the GNU and proposed a solution that all individuals could have got behind. And this probably should have been done weeks, if not month or two ago. And then secondly, the president himself as leader, and by the way, he's known for his negotiation and ability to collaborate, should have then facilitated to completion the budget so that it was ready on time and delivered successfully. So that's the first insight that you and I can get, is that, in fact, I'm not worried about the GNU continuing in a functional manner. In fact, we're beginning to see the benefits of it. But I do worry when we look deeper at the leadership roles and their ability to actually deliver. That's the first thing. You yourself, Stephen, actually talked about ideology. And if you look at the ideology, I'm seeing the likes of Mark Barnes, Peter Bruce, and so on in the Business Day and other commentators beginning to touch on this subject. But really what we're seeing here is the elephants hitting head on between the ANC ideology of the last 3 decades, which I might hasten to add has not delivered economic growth or extra jobs. And then let's say the GNU partners, the new partners of which, of course, the DA is the biggest, but there are others, bringing potentially an alternative ideology. And in fact, the money talks, and that's why there's been a sticking point on the budget. But I foresee that really I'm not seeing the leadership, certainly of the ANC, now that they're not the majority ruling partnership, being able to pivot in an agile way to say our ideology and therefore the strategies from that ideology have not delivered. How do we co-opt potentially new thinking, maybe slightly more free market, as opposed to, let's say, communist socialist ideology that may have built RDP houses and given free education, but certainly is not delivering jobs or economic growth? How do we co-opt other ideologies to be more successful than where we are. And my insight here, Stephen, I'll be interested to know how you and the listeners feel, is that this is not going to be the first banging of heads. And until we unpack these alternative ideologies and there is a coming together, as the old Afrikaner used to say, a toenadering of the thinkers in leadership towards an agreed future, I can't see that we're going to have a aligned ability. And so I'm waiting for March the 12th. Because if I'm on either one of these sides, the only way to proceed is to really take off the me first hat and begin to say what's best for our country. And I think we've seen we need economic growth, we need jobs. It's as simple as that, and we probably don't need more taxes. So that's how I've unpacked it, Stephen. I don't know if you've got any thoughts.
Well, I mean, I suppose the other question is what happens next in terms of actually the negotiations. And the problem is that the DA has said we will not accept a 2 percentage point VAT increase. They can't concede now. And all of this is going to happen sort of in public through leaks. So now, and we've only got 30 seconds left, comes a real test of leadership about conceding in public.
I think that the key here is that leaders are responsible for vision and culture and values. And this is the alignment of values where the old ANC ideology is not functional. And I think they could do a lot worse by fighting. Rather, they should co-opt some of the good ideas that maybe some of their GNU partners are providing. And I think it's a rethink of the budget as presented. And that's the best, I think, as a citizen of the country you and I can hope for.
Thank you very much indeed. Andrew Woodburn, Managing Director at Amrop Woodburn Manny with The Money Show, 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporates and Investment Banking, proud host of Beyond the Budget 2025, where they are reimagining inclusive and sustainable economic growth. Good evening. Welcome to the second hour of the program. We'll talk about LinkedIn. If you're on LinkedIn, if you've given them some of your information, I have. There are suggestions that it may perhaps be used for various reasons. Siphumelele Zondi's been looking into that. A bit of a court case that's been running for a while, but there are some important developments within it. We'll talk about small businesses in a little while. Banele Rewo is the creative director of 0 to Million. It's a social entrepreneurship campaign. He spends his time particularly talking to young people about starting businesses. I've always sort of had this feeling, from time to time I've spoken to government officials, in interviews, and they'll say, in public, in an interview situation, they'll say something along the lines of, we don't think young people are entrepreneurial enough. And I almost want to scream and say, you are a government official, a politician, and you dare say that young people are not working hard enough to fix the situation that people of my generation created. I mean, how dare you? Well, we'll talk a little bit about that. It's about the hustle in a way, but we'll talk about that. And then risk tolerance. I nearly said wheat tolerance. Risk tolerance, your tolerance for risk, which really is what defines you as an investor. Is a conservative approach still such a good idea? We'll be speaking to Gary Boyson and Owen and Cormore about that from 7:30. If you consider everything that's going on in the world, how the gold price has suddenly become a major feature of the Money Show, well, risk tolerance is really what it's all about. Maybe something in you for that from 7:30.
702. Stephen is on X.
At Stephen Grootes.
Be interested to know if you're worried about this, if you're on LinkedIn, 011 883 0702 021 446 0567. And LinkedIn, as you know, they now have over 1 billion accounts. People go there for all sorts of reasons, but they're now being sued over claims that the data you would have given LinkedIn is being shared with third parties to help train AI platforms. Siphumelele Zondi is our tech expert. Siphumelele, good evening. Who's suing LinkedIn? I mean, what evidence is there that this data would have been used without us knowing to train artificial intelligence platforms?
Hello, Stephen, and thanks very much for inviting me. So it's a group of premium subscribers of LinkedIn in the United States of America who say that they have reason to believe that the data is being used to train AI. They say if you initially there was an opt-in button where you could be told that data could be used and you had to opt into that if you agree that your data might be used to train AI. But then after it wasn't an opt-in feature, it basically was directly alerting you that your data could be used to train AI, which then they say made them believe that data is actually being used to train AI, as opposed to you having a say on whether you agree to this or not if you use LinkedIn. And they are premium subscribers, so they do pay for the platform. So they feel that they should essentially have a choice of whether they agree with this or not.
I mean, hard to argue with them. It's not just LinkedIn that does this. Other people do it too, right?
Totally. There's been various platforms that have been accused of sharing user data, especially with training different AI platforms. The latest one is actually the ByteDance scenario, where South Korea, the government there, is accusing ByteDance and DeepSeek of sharing user information to the point that they have tried to alert their citizens to limit their usage, and especially not government officials. We do know that a couple of governments have raised issues with this, and this has raised alarm with a couple of people in different parts of the world on DeepSeek and how it's actually getting its information, because it has been hailed to be a cheaply made platform that seems to work super fast, much faster than platforms that existed for years before it, that have been doing the training for years. And there have been questions on how that's happening. And the South Koreans believe that there's a bit of user data sharing with TikTok.
I mean, it's fascinating to see how all of this works. But I mean, in the world of training these models, you need huge amounts of data to do it. Social media or institutions, all of them, generate the huge amounts of data, and I suppose in some ways very high quality data, because it's human beings playing with information, and that's the kind of data that they want. I mean, can you really stop it from happening? If I go onto X, if I go onto LinkedIn, if I go on somewhere else, I mean, how do I make sure it's not my data that's being used? And how would I even know?
Well, that's the thing, right? Because you can't know for sure what's happening in the back end, and also a lot of these AI models are being built or partly funded by already existing tech organizations. When you think about OpenAI, for example, where Elon Musk, for example, was a big proponent and a big funder of OpenAI, and you then think about Microsoft also having been a big funder of OpenAI. Microsoft, by the way, also owns LinkedIn, and they've done so since the year 2016 when they bought the platform. So because a lot of these tech companies are also funders of these new AI models, you'd find that there could be a few leaks that might happen from the platforms that they already own to the platforms that they are working with and that they are funding and that they probably are helping build themselves, because they do need to get data from somewhere. So there will be leaks there and there, and I think there probably is no way of ensuring for sure that this doesn't happen.
I don't share a lot with Elon Musk. He was at a similar high school to mine. He's a little bit older than me. We were at different eras. But unfortunately, I must confess, we had the same tastes in science fiction as younger people. He read a book called Stranger in a Strange Land, and from that book, he got the word grok, which is more than just sort of thinking and understanding. It's really a kind of merging and therefore fully understanding. There's a religious aspect to it too, but that's not really what the book's about. And he's named his AI engine Grok. And I mean, he's done that for a very specific reason. And I realize that it's embedded on X, but I know nothing about Grok compared to what I know about ChatGPT or DeepSeek.
Grok 3 actually launched this week, so this is it's sort of like a soft launch, right? Because you sort of see this icon appearing on X, and you almost are unaware of it. And at the moment, it's only open to premium subscribers. We do know that's when Elon bought the platform that was Twitter and renamed it X, and then he introduced a premium subscription, which then allows you to post longer format information, and then would allow you to edit your posts, which have now been changed from tweets to posts. You're allowed to change, and now you can have access to Grok, which is an AI model that is now embedded into this. And then you can go ask Grok certain information. If, for example, you want to verify something that someone posts on the platform, and you can go and you can sort of like ask it to verify that information and whether it's true. It's going to look at whichever platforms it looks into across the web, and then it brings back that information to say, well, we verified that it is true, and or actually according to that and that and that information can't possibly be true. So it's come with, and also as it launches, it's almost as if it launches and the that premium subscription also doubles. Almost, because it's now increased twice. It's almost $50 that comes with now this embedded new feature that you can get if you're a premium subscriber. And at the moment, these are all being trained, right, in order to absorb all this information and the information that you post and figure out who we are and what we do and where we live and what happens where we live, in order for them to then regurgitate this information and bring it back to us.
Siphumelele Zondi, thanks so much. Really appreciate it. Tech expert. Fascinating just to see. And I mean, I suppose the problem still boils down to you just don't know where your information is going. Goes back to the old thing about social media. If it's free, the product is you. 16 minutes after 7.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Small Business Focus is brought to you by Capitec. No matter the size of your business, Capitec's got you. Lots of different ways to try and encourage small business. One person spends a lot of time talking to younger people to educate them about how to start small businesses. Banele Rewo is the creative director of 0 to Million, the social entrepreneurship campaign, also the founder of the Z2B Wholesaling and Aquaponics Stokvel. I have to tell you, Banele, good evening. I don't think I've ever used the phrase Stokvel and Aquaponics in the same sentence before.
It is the first time, and it's brilliant.
It's really quite amazing. So you like to educate young people in how to start a business.
Correct. I do.
And I mean, the kind of information you're trying to get across, I mean, some of it will be a bit dull, manage your accounts, do this, do that. But quite a lot of it must also be about the kind of sense you need to have to run your own business.
100%. That's why I wrote the book, which this is where everything started from. It's called Nomayini, the mentality you need before you start in a business. And I chose to focus on the mentality and the psychology you need to start a business, particularly if you're a young person from the townships and from the rural areas. So that's where I decided to focus on.
I have this idea in my head that you know, people are sort of looking for, they're hustling and they're looking for an opportunity to hustle. And it's a bit about harnessing that in a way.
Correct, 100%. We need to actually move from hustling to starting businesses, and from starting businesses to scaling. So we need to shift the way that we actually tackle business. If we're going to aquaponics, it's quite a novel idea, and it's unexpected to hear about aquaponics in the township. So that's where we need to be going. We need to be getting into these businesses and these sectors that are unfamiliar currently in our communities.
I made the point a few moments ago that I've spoken to politicians, to sort of government officials, my age and older, right? And they'll sometimes, and I've heard one or two of them had a big fight with one who said to me, well, young people aren't entrepreneurial. And I kind of wanted to say, ma'am, you work in government. How dare you? And in fact, my experience has been that younger people are far more entrepreneurial than my generation. They're entrepreneurs of my generation, sure. And you find actually that people are really they're fighting for any opportunity that they have.
100% they are. I think there is a disconnect between what government wants to achieve, because there are programs that are set out for young people. And then on the side of the young people, I think one of the things that I've seen to be an Achilles heel for young people is that they expect funding, and how they see funding, they see it as basically a gift. You know, it's not like a loan or anything like that. They're basically waiting for someone to give them money, and then they will start a business. But it doesn't work like that. You actually first have to figure out how to get the capital. Even if you have to keep a job and then fund capital, then you get funding for scaling. So there is that disparity between the two. And what I'm trying to do is actually bridge the two and show that you can actually start a business, bring a community along with you, and then you can approach government, because government wants to see people, it wants to see businesses succeed. Young people want to see government work with them. But if we don't bridge that gap, then we have the situation that we're dealing with right now.
What kind of questions are you finding that younger people are asking you?
They would be asking for a lot of mentorship. How can I get funding? What business can I start? I'm depressed. What can I do? That's a big one. And I always answer it by in various ways. However, it all boils down to you have to take initiative, but get information. Right now, information is so easy to access. You have your ChatGPTs. I mean, you were talking about AI right now. Information is easy, but the challenge is to putting it together. It's one thing to be exposed to information, but it's another to be able to actually take that information and put it together in your mind and then apply it. So we need that application education. That's why I decided to show them by starting this campaign 0 to million. I said, let's start a business from 0 and take it to 1 million. And I'll show you step by step how I did it. And this took 2 years. And they've seen this thing. It was also a social experiment, but they were exposed to how it can be done.
So, I mean, we have millions of people who don't have a sustainable income in our country. And I think many of them might be listening now, and they might talk about the depression that I know young people in that position feel. And they might say, well, you can do it, or this person can do it, but I can't. My equivalent of that would be, I may be roughly the same age as Elon Musk, but I'm not Elon Musk. So I mean, for people in that position, I think they yes, not everyone is born with confidence or has the gift of confidence, but they still want to hustle.
Yeah. You might not be born with the gift of confidence, but you're born within a community. And let's take it back to when you said you've never used the word aquaponics with Stokvel. Let's talk about Stokvel itself. It started way back when people did not have the opportunities, and they decided to come together, and it afforded them the opportunity to bury their loved ones and actually buy a lot of groceries in December. But now, as young people, we need to elevate that and take the Stokvel model and crowdfund it, right? And as a crowdfund model, and then build businesses. You don't have. I was able to do it because I have a fairly large following. However, you can do it with your family. I mean, 10 members of your family, that's a community. And if they contribute 100 Rand a month, that's 1,000 Rand. It's 12,000 Rand. That could be a start of something. So I cannot argue with someone who says, I can't do it, because then you believe that you can't do it. But if you say you can do it, but you ask me how, then we have a conversation.
You mentioned some of the government programs. I mean, there are lots of government this, government that. Government always talks about helping small business, never pays it. And I mean, there's a small business development ministry, which I hear nothing from. And one day the minister's going to phone in, because I've said that on this show many times. Never hear from the minister. Is any of that having any impact, the stuff that government is doing?
But to be honest, I would wish a lot more was being done in terms of government assisting. But there is that challenge that we're talking about, Stephen, which is there's far too many people that are looking for opportunities. So if you are going to, as a government entity, if you're going to help like 1 or 2 people, and in most cases you find that they help someone who's already about to make it, and then they're propelled into this stardom sphere, then that is problematic. We need new ways, and I believe that working as a community-built businesses and crowdfunding is the solution. That can actually help young people fast-track their way to get into those offices where government is saying, okay, we're ready to listen, because here you are, you've raised yourself 100,000. So what else do you need?
Banele, it's really good to meet you. Thank you so much for coming in. I really appreciate it.
Pleasure.
Banele Rewo, the creative director of 0 to Million. It's a social entrepreneurship campaign, the founder of Z2B Meat Wholesaling and the Aquaponics Stokvel. The book is called Nomiyini.
The Money Show.
Investment School.
Well, the whole point of investing really is to manage risk. You're putting money into something, you don't know what the outcome is, and that means that your approach to investing is really about your approach to risk. And tonight on Investment School, we're talking about risk tolerance. Gary Boysons, director at Rand Swiss, in our Cape Town studio. Owen and Cormor, the CEO and founder of the Nkunzi Wealth Group. Gents, thanks very much indeed for coming in. Really appreciate it. Good evening. Owen, if I can start with you. I mean, risk tolerance, once you work out your risk tolerance, I imagine that's almost the beginning point of investing. You've got to know how much you're prepared to risk and what you won't risk.
Exactly, and I think that the issue with risk tolerance is that it's a very confusing element depending on who you're asking what their risk tolerance is. You could find that two people that believe they've got totally different risk appetites actually can invest in the same thing, which actually turns out to be very awkward sometimes when you have to account and explain that, no, but remember when we did your risk assessment, which we're expected to do as investment managers, you need to check what everyone's risk appetite is before you put them into a certain product. So unfortunately, most of the time, guys get confused. And the process itself of determining risk is not an easy one, Stephen. The questions just confuse investors out there, and the guys just end up ticking anything. But the important thing is, I think if you give them explanations that are simple enough for them to understand, you guys should be able to meet each other halfway in the event that something goes wrong.
Gary, I mean, is there a definition of risk or risk tolerance? And I know, particularly at this moment, the definition of risk is sort of being hotly debated.
Well, yeah, yes, there is a definition of risk tolerance. So there's actually a couple of different things that you should be looking at. So there's risk tolerance, risk capacity, and risk required when you're doing a risk profile for a client. So the risk tolerance, which is what you're talking about, is really the psychological makeup of the client. How do they feel? How are they going to react emotionally when the market is down 30%? Are they going to panic sell? And as Owen was saying, you've got different ways of measuring that. You've got the quantitative ways of measuring that, which is, and there's plenty of tools. I think one of the most popular is probably Phenometrica. And you've got everything from very complex tools that will give you a zone of composure for the client, that'll tell you this is how aggressive you can be, or this is how conservative you need to be before the client psychologically is going to take strain. And then there's also the qualitative approach, which I think is far better, because I think too many people do that tick box exercise. They put something down, they say, tick these 10 questions. How would you feel if your portfolio went down 10%? Oh, I'd feel bad. And then they try and come up with a numerical score. But that's only one aspect to it. I think the qualitative approach of sitting with a client, understanding who they are, actually getting to know the person that you're working with is far more useful. But yeah, that's one aspect of it, because you've still got that risk capacity and you've got the risk required that you have to do to complete a full risk profile.
So, I mean, Owen, when you try and complete a risk profile, what kind of questions are you asking? And I mean, I've been in situations where I'm not an active investor myself, but people will be moderate aggressive, this aggressive, whatever. It changes often as you get a little older. You sort of want to be a little bit more safer because you're going to need that money. I mean, what kind of questions do you look at?
Yeah, so the basic questions that you're asking are related to the idea that we can quantify your emotional responses to circumstances, your emotional responses to perceived losses or perceived gains, the emotional responses that relate to, the question that says, if you had 100,000 rands and there's a great opportunity here, you can make 20%, but there's a chance that you can lose all of it. Would you be willing to take the chance? Or if you put in 100,000, just how much of a return would you be expecting? So you're trying to reverse engineer this person's emotions. And, it's very easy to do, Stephen, doing that, right? So I think that, those kind of questions, and whether people have invested in this particular asset class or in this particular product, in Forex, for example, or in the equity markets, or in the bond market, or in unit trusts and any other product that we actually do invest in. Those are the questions that we ask. If you've ever invested, how did you feel when the market went down 20%, when the market went down 40%, during the last Great Recession, during the financial crisis, and you understand that those market declines, might not necessarily persist for a very long time? Would you be able to wait if the market came down, or you would choose to take your money out of the investment? We just try to get a sense of where the client is positioned regarding those questions. And then out of doing a certain metrics, you add up those points, and then you decide that this client is a low-risk client, medium-risk client, and then, a high-risk client. But the disadvantage of that, Stephen, is that you're actually being very mathematical about something that I have learned over the past 20 years I've been working in the markets, that the biggest manager of risk, there's two important things that you need to do. Choose the right investment from the beginning, and at the same time, you need to have time on your side. If you do have time on your side and you've chosen the right investment, I think you've done the bulk of the homework. You don't need to stress about the investments overnight.
And I suppose, Gary, we shouldn't forget what's really at the back of this, which is the reward, right? I mean, these are the flip sides of the thing. People will take a lot more risk if they think they're going to get a lot more reward. The point is that you need to find some kind of happy equilibrium between those two things: potential reward and risk.
No, absolutely. And I suppose what you're talking about there is what's called the efficient frontier. So, a low-risk investment typically has low risk, low reward. And you can think about that like your bank account. You stick it in there's going to be no volatility. Volatility is a measure of risk. How uncertain are the returns going to be? And then obviously as you move up, you move into the bond market. Bonds are, typically higher risk than a deposit at a bank. So you can expect slightly higher returns. If you go in government bonds, those are seen as more secure. But if you go into, say, corporate bonds or junk bonds, for example, you start moving up the risk spectrum. And then finally you get to property and equity. And again, it's very broad definitions because, if you think in the property market, a lot of people understand property, a house in central Sandton versus, a house somewhere in a dangerous neighborhood, that has two very different risk profiles, even though it's within the property asset class. Equity is generally seen as a higher risk, higher reward investment. And I think what's important to understand is as long as you're on the efficient frontier, we consider that a good investment. What you're trying to avoid as an investor is things that sit off the efficient frontier. So something that's going to be high risk, but actually give you low reward. That's just a junk investment. And there's plenty of them out there, and there's many reasons why those exist. It's, really high fees, just very poor, investment construction. And then, of course, you've got the flip side of it, anything above the curve, which is things that offer you very high reward at very low risk. And 99% of the times, those are just scams. Those are people promising things that don't exist.
Yeah, I mean, that's the other thing. You've got to be so careful of those now. I mean, there's so many of them. So there's an efficient frontier. What is that?
So it's basically a theory that tries to compare, the relative riskiness of assets, that puts assets with different risks and different returns in a line that creates a curve that shows that the higher you go up the line, you're taking on more risk, but then by doing that, you're actually also assuming potential of having more returns. But then again, I'm not going to use the efficient frontier hypothesis when I'm talking to someone who has never sat in front of an investment management lecture. You want to try and bring those down to a level where they can understand what you're talking about. But in short, that's what you're trying to do. Yeah.
Gary, you were talking about questionnaires. So someone will come in and say, I believe that my risk profile is X, Y, Z. I want to be aggressive, or I don't want any risk at all. And then they do the questionnaire, qualitative or quantitative. Do you find that actually people surprise you? They may think they're one thing, but actually they're something completely different, just because they've never really thought about it.
Yeah, absolutely. It happens all the time. There's often a misalignment between what they think they want and what they actually need as well. So, on the one side, I mean, Owen made a great point earlier. One of the biggest, clues as well is looking at an existing investment portfolio and looking how the investor has already constructed it. So, if an investor comes to you and says, "Oh, well, I'm I like to take a little bit of risk." I actually remember a client like this says, "I'm a farmer and I when it rains, I make money and I'm quite used to volatility." And then I looked at the investment portfolio and it was pretty much all sitting in cash. And you're like, that's giving me a clue that you might think that you're incredibly, you love to take on risk, but everything about your investment portfolio currently is telling me that you are super risk averse. And then, like I said, you do the quantitative stuff, you put them on a questionnaire, but you've got to think about it. It's essentially a psychometric test. And you can think about, meeting a wealth advisor almost like doing a job interview as well. Would you just hire someone if you just put them on psychometric testing? Of course you wouldn't. It's a combination of the two. They might come out and say, hey, you've got great aptitude, the personality matches our culture, but you would never hire someone that you had never actually done an interview. You need to meet them in person. You need to understand who they are, because so much of the qualitative stuff actually gets you to the heart of what the investor is going to need and what is appropriate for an investor to build a positive relationship.
Oh, and there must be a real science in developing these questionnaires, and there must be questionnaires that compete with each other, and there must be questionnaires that take completely different approaches.
Yes, there definitely is a science, but I'm not smart enough. I'm not a natural scientist. There's a clever guys that sit and create this kind of questionnaires. They've gone to university, they've studied basically behavioral science, behavioral finance rather, that we discussed on one of the shows here in the investment school. So they go out there and they analyze thousands and thousands of samples in terms of people's responses to, investment risk, investment return, and just to get a sense of what people feel comfortable investing in. And I think that what I've seen over the years is that risk questionnaire, in my view, is really mostly done for compliance purposes. Because what ultimately then happens is you figure out that someone says that they are on the low spectrum of risk, but they've given you R1 million and they want to earn 7,000 rands a month for the rest of their life. And, depending on what investment you put them in, if you do that, you actually have to use your own objective, qualitative assessment of the client's scenario and position and say, it's irresponsible for me to put you in a stable fund. I need to put you in a balanced fund. Let me move you up the curve in terms of, making sure that you've got a bit of exposure into the equity markets. And then the one thing that I've picked up over the years is that people are really just scared of the stock market. They hear stock market and they think stock markets fall, which is actually great. It's a reality, but if you compare stock markets from the early 1900s to now, the number of times the markets have fallen on a percentage basis, it's probably between 10 and 15% on a relative basis if you look at the time length between the 1900s and today. And when the markets fall, they only fall for about 1 to 2 years, depending on the depth of the recession being experienced at that time. So it's very important for us as investment managers and financial advisors to talk to these clients and indicate to them, you are investing, you're 55 years old, you're going on retirement, and you want to make money for the rest of your life, and you want to make sure that the money that you have now sustains you. So what's the point of me putting you in a stable fund that's going to give you 7 to 8 or 9% when your drawdown rate is going to be anything between 10 and 12%? You need to actually say what you have on your side is the fact that you're only 55, you might live to 70 because of health improvements or healthcare industry improvements, the use of medical aids and things like that. So just give them the comfort that as long as they've got time on their side, they can move up the curve in terms of risk so that they can secure higher returns as well.
It's a fascinating question, I suppose, the whole idea of what is your tolerance for risk, and it's something that people don't generally think about it. Well, we'll continue the conversation in just a moment. Gary Boyson's director at Rand Swiss, Owen Nkomo, CEO and founder at the Nkunzi Wealth Group, talking about risk tolerance on Investment School tonight.
The Money Show.
Investment School.
We're talking about risk tolerance this evening on Investment School. Owen Nkomo, CEO and founder of the Nkunzi Wealth Group, Gary Boyson, director at Rand Swiss. Gary, so many people look for that 1 in a million chance, and they think for some reason that they're onto something, and often their source of information is one person, or it's someone in their family, or it's just the owner of the scam or whatever it is, and based on information from 1 or 2 people, they put their life savings into it because they think they're going to go from X to literally it's going to be like winning the lottery, and obviously that is not how investments work. But what does that tell us about those people? I mean, are they desperate or are they just risk takers?
Well, it tells us that they probably have a very high risk tolerance, but what they're not considering is the other 2 legs of the 3-legged stool, which is risk capacity and the risk required. So someone that's putting their entire life savings on a 1 in a million bet, they're just spending all their money buying lotto tickets, they haven't looked at their overall portfolio and said, how much risk what is my financial ability to take this level of risk as well? And that's an important consideration. You've got to look at the existing portfolio and say, is it appropriate for me to put everything in this? It's clearly a speculative investment. I don't want to do that. And at the same time, they've got to look at their objectives as well. Is their objective to be able to retire comfortably? Is their objective to save for school fees in a year's time? If those are the objectives of the client, then you can work backwards and work out the risk required. And the risk required to save for a car in a year's time, or have a successful retirement, doesn't require you to take that level of risk to go and buy all those lotto tickets and do the 1 in a million chance. So it's also about sensibly looking at where you are as an investor and what kind of returns you actually need to generate to achieve your goals.
Owen, I mean, we see people falling victim to scams, pyramid schemes, things like that. And this, I mean, is a reflection on sometimes the desperation of people, but that hunger to sort of literally win the lotto.
Yes, it is. And I think that it's quite unfortunate because most of the people that get involved there are people that actually cannot afford to invest. And it's people that see this opportunity that's promising an unrealistic return. And I think on the show here, we once discussed, issues relating to pyramid schemes, say how to identify them and all of those things. But people just don't want to learn. I think it's not that they don't want to learn. They choose not to learn because they're told every time that if it is going to give you returns in a short space of time and the returns look too high, ask yourself why Standard Bank does not have a similar product.
Yeah.
Why doesn't the banking industry or the investment managers have similar products? And I think that people choose to rather invest in hope. I hope I'm right. I hope I'm the first in the queue. I hope I'm one of the guys that are going to get paid. But before you know it, that thing has collapsed. And the shocking thing is that the same guys that are running that scheme, if they open another scheme next door, it's the same guys that are investing in the previous one that will come and invest. But definitely people are desperate to make money and they want to make it quick and they want to make it big. But unfortunately, investments don't work like that. You need to have time on your side and you need to choose the right investments, diversify your portfolio, and obviously, talk about this conversation around risk. And, when we talk about risk as well, we need to talk about the big picture where you're looking at the asset managers in the country and in the world, where they look at a company like your Tesla, look at your Naspers and your Prosus and all of those beautiful companies that have continued to do well. But some asset managers, because of their strategies, they've looked at it and said, these stocks are very expensive. We cannot afford to buy them at these levels. So what does that do to them? It means they think that for the returns they're going to get, they're paying just too much and they'd rather find it elsewhere. But unfortunately, what happens is Elon Musk becomes friends with Donald Trump and Tesla just keeps going, and then you've missed those returns. So the risk adjusted element of where we invest, which we call a Sharpe ratio, is a very important consideration as well. But this is if you're talking boardroom conversations around investing, because you need to look at your risk adjusted returns. Are you taking on just too much risk to give certain returns for your clients, or you taking moderate risk? So yeah, it gets interesting once you move into the boardroom relative to investing for individuals. Yeah.
No, it must be fascinating. Gary, can you look at the investments someone has made and work out what the answers to their questionnaire would have been? Can you reverse engineer it?
You probably could get quite close, I'll be honest. So yeah, like I said, looking at someone's investment portfolio and how they've constructed it, as long as they had an idea and they understood the products that they were investing in, of course, it gives you a great indication of what their risk profile is. And I think what you find is, specifically as investors get older and older, that risk tolerance, the psychology around risk diminishes greatly. And often what we see is it's an inflection point. Younger investors happy to take on the risk, happy to kind of go into equity markets, go into more growth-orientated assets. But as an investor gets older and they kind of get to that retirement stage, they retire, and suddenly they realize that there's no more money coming in, and the risk tolerance changes dramatically. And you suddenly see guys that were fairly, well positioned, probably had a fairly balanced portfolio in, let's say, their 40s or early 50s. Suddenly they get to retirement, they stop working, and it suddenly goes to an ultra conservative portfolio. And then what they run is a different type of risk. So now you're running a longevity risk and the inflation risk. So the fact that because you're investing so conservatively, let's say in your 60s and 70s, you might actually run out of money, or and that's the longevity risk, you might outlive your money. And then of course the inflation risk as well, that suddenly you're going going, I'm happy with my kind of bank deposit return, but that's not going to be the return that keeps pace with inflation and actually grows your assets enough that you get a positive real return, so an after inflation return.
And I presume that age was going to come into this at some point. And I suppose, Owen, nowadays, I mean, the question is, so for years, gold has been seen as a safe haven, right? So that would be the ultimate non-risk asset, in a way, unless you were going to keep it in cash. Now, with gold prices at these levels, you could make a big profit on gold, or you could find out that actually it gets to 3,000, goes back to 2,500, and you lose a lot of money. So even though the risk appetite might stay the same, an asset class can change over time.
Yeah, that's true. I mean, that's why we've got things like cryptocurrencies now that can actually safely claim to have their own space in the asset classes available to people for people to invest in. And again, you talk about gold. Gold is a typical classic example of the fact that when we invest in the markets, it's nothing but a confluence of our perspectives relating to a certain investment. What income does gold produce? None. It doesn't produce any income. It's just a precious metal, and people decided one day that, it's better to put money in physical assets and gold. We like gold, so we're going to keep pushing money into gold. So with all these concerns these days around inflation and where the markets are going, people have been piling into gold for the past year and a half odd. But no one can give you the scientific calculation and explanation as to why the price of gold is trading there. And I guess, again, it goes back to diversifying your portfolios. Don't just have them invest in gold because gold is running. Because it's going to take something, that could happen in a jiffy, and gold price can pull back. But I guess we have to keep educating people about all these investment risks. And, their tolerance is very important. Gary talks about age. We emphasize that it doesn't matter how old you are. You must make sure your portfolio is going to look after you. Don't live on fear, but instead it's easier to look on the bright side and say, if I'm around, I want to make sure my portfolio is still cooking, even when I'm no longer here.
Owen Nkomo, thank you so much. Founder, CEO of the Nkunzi Wealth Group. Gary Boyson, Director at Rand Swiss on Investment School.